Hi, this is Eric Janszen of iTulip. Today, iTulip is privileged to interview Dr. Michael Hudson. As an advisor to the White House, State Department, and Defense Department at the Hudson Institute, he is one of the best-known specialists in international finance. Dr. Hudson is a Wall Street financial analyst and distinguished research professor of economics at the University of Missouri, Kansas City. He has written or edited over 10 books on international finance, economic history, and the history of economic thought, and has been an economic advisor to the U.S., Canadian, Mexican, and other governments and United Nations agencies, as well as the international corporations and money managers. He is currently engaged as a consultant to the governments of China and Estonia. Dr. Hudson is former balance of payments economist for the Chase Manhattan Bank and Arthur Andersen. In 1989, he organized the world's first Third World Debt Fund for Scudder, Stevens, and Clark. He continues to conduct statistical research for financial and nonprofit institutions, including the Levy Institute. Dr. Hudson is president of the Institute for the Study of Long-Term Economic Trends in New York and London. Among his books on politics of international trade and finance are Super-Imperialism and Global Fracture. Welcome, Dr. Hudson.
You talk in the article about debt deflation that posted on iTulip last week about how the exponentially compounding debt system has been evolving over the last few decades. So some of my questions are really around where you really think it's going. If you think that the ultimate outcome of this finance-based economy will either be in the form of some sort of regression to the mean in terms of debt levels and so forth, and for the country, the private and public sectors, and how might we get there?
The idea of regression to a mean is a false idea, not because it implies that there's just sort of a gradual, almost a cyclical curve. Everything in the 19th century, they had a very different view. Instead of the business cycle, they saw an exponential upsweep and then a sudden downturn, a sudden crash. Then it's like a ratchet effect. An exponential rise, then a sudden crash down. And I think I had that chart in both the Harper's article and in the Kansas City article.
One of the criticisms that we have sometimes on the site of standard neoclassical economics is it talks about business cycles, and cycles are, I think you'll probably agree, is probably the wrong model. It's sort of borrowing from physics, and it doesn't really. There's
never been a business cycle in history. No time in any country. It's the idea of a business cycle was put in to imply that the economy is self-regulating, and that when there's a downturn, factors will create an upturn again. This was all done basically by Wesley Mitchell at Columbia University. There's no evidence whatsoever that economic phenomena are self-regulating. It's easier to think of the economy as two systems in which the financial system imposes a constraint on the production and consumption economy, and the constraint causes a collapse, then it goes down. But it's not a cyclical pattern at all.
So it's this economy is essentially grow in this sort of ratchet effect.
Sweep and then a sharp downturn, upsweep and a sharp downturn, and I think I had those charts in my articles.
Yes, he did. The net effect, 2 steps forward, 1 step back process, but not a cycle.
Right.
Okay. So, and in each case, does it change in some fundamental way through each one of these
Yes, and underlying regression equations are the assumption that the environment remains constant, and the environment is continually changing. The institutional environment and the debt environment is changing. So the finance, insurance, and real estate, the FIRE sector, is the wrapping around the production and consumption economy.
Okay.
And that's what's changing continually at a different rate. Yeah. And they're two separate systems.
Yeah.
The fallacy of neoclassical economics is to imagine that the credit and monetary system follows endogenously from the production and consumption economy, and that's not true. Neither the property economy nor the financial economy, it follows from the production and consumption technology economy. It's independent of it, and that's why you have, for instance, the Soviet Union, the United States, and Japan and Europe all had similar technologies, but they had very different financial and property systems.
So in each one of these, let's refer to them, since they're not cycles, as instantiations of the ratcheting process. Is there anything that is regular about the way that it changes in each instantiation? No, that everyone is different.
Well, the common denominator is that financial claims for payment grow exponentially faster than the economy's ability to pay. That's the common denominator, and that's why Adam Smith said that no country has ever repaid its public debt, and he could have said private debt either, although private debt in his as it is now.
So that leads directly to our next question, which is, in every case, when the carrying costs of debt exceeds the ability of the economy to produce the income to pay it, there is some kind of default.
Yes.
What determines what...
A break in the chain of payments is what it was called in the 19th century.
And this break in the chain of payments, sometimes it seems to take a deflationary course, and other times it seems to take a hyperinflationary course.
That's right. It was deflationary as long as countries are paid in gold. The hyperinflationary course, in all cases, stems not from what Milton Friedman said, from the increase in money, but in every case from the balance of payments deficit resulting in the need to finance foreign debt. Friedman knew this. He deliberately rejected it, and the fallacy of almost all of his monetarist formulas comes in he thinks that you can inflate your way out of debt, and of course that's not true when the debt is owed in a foreign currency, as Germany's was in the 1920s and as Latin America's was later. So Friedmanite became essentially a lobby for the IMF, claiming that any country could handle its foreign debt simply depreciating its currency, which of course just increased the overhead of the foreign debt relative to the domestic ability to pay.
So one of the classic exceptions is the case of Japan, which has experienced, even though it's a fiat money system, when they experienced a debt collapse starting around 1990, they have experienced what people call deflation, but...
And it is a deflation.
Yeah.
In other words, the hyperinflation of the currency is a form of debt deflation. What it means is that all of the surplus goes to pay the foreign debt. And I trace all of this in my book on superimperialism, where I describe how Germany tried to repay, and I also describe it in my Trade Development and Foreign Debt, on the chapter on the German hyperinflation. Keynes is very clear that what Germany did in trying to pay its debt not only was to divert its economic output to the creditor nations, but also a huge sell-off of its property to the creditor nations, and in effect there was a huge foreclosure process on the German economy. So the German hyperinflation was a debt deflation, and hyperinflation was its means of coping with the debt deflation.
So let's talk about some more modest forms of debt deflation that we've seen, such as when the Soviet Union collapsed and Russia was formed, and there was a very high rate of inflation. According to the report that I sent you from the doctor over there at Rutgers, it was somewhere around 1,200% for a period of time. And that wiped out everybody's savings, and of course also wiped out all the debt. But that didn't last very long. Within a couple of years...
The purpose was to wipe out people's savings. In other words, the IMF sponsored a meeting in Houston where it said the first thing we have to do is wipe out everybody's savings, then we have to privatize under conditions where there are zero Russian savings, so that all of Russia's industry, all of its resources will be sold to foreigners. But in order to destroy the Russian economy, you needed to wipe out everybody's savings through the hyperinflation. It was deliberate, pre-planned, announced in advance by the IMF, and accepted by Russia.
So you would expect that if it was pretty well known by anyone who was in the know at the time in Russia, that they would have had the foresight to get their money out before that happened.
And in fact, that was already happening from 1989, largely through Latvia, through Lochanski's operation there.
So from 89 until they essentially crashed the economy around
there was a huge capital flight out of there.
Would you describe the capital flight as a antecedent to this kind of event? Is it
No, it goes together with it. I mean, as you said, people in the know were already getting things out. The army was getting its money out. Most of the money was gotten out through false export invoicing, and because Latvia at Ventspils was the place in which Russian oil was at that point exported, that was the easiest place to get money out. But also, Lochanski had organized a whole system of money laundering through Latvia, which is still Latvia's role in the Russian economy today. There are all these bank bills is Russians are still moving their money to the West via Latvia.
So let's take a different example. How about Mexico, where they had their period of pretty high inflation, which they then later got back under control. Did that have the same effect on savers and on their foreign debts and domestic debts?
What years are you talking about?
Well, the early 90s, right? Or was the late... It was,
in 1990, Mexico was paying 22.5% on its peso bonos. And they were also privatizing the telephone and the other industries, and of course this led to a huge outflow, in addition to giving a bonanza to people who held the peso bonos, which are dollar-denominated bonds. Most of the holders of the dollar bonds were the Mexican upper class. And of course they blamed the Yankee dollars, the Yankees, for exploiting them, but there were very few Yankee holders of these bonds. In fact, the first was the bond fund that I was running through Scudder Stevens.
So the folks in the know in each of these cases, anyone with any significant net worth with any connections inside of Germany was getting their money out before that hyperinflation, likewise in Mexico. Getting back to the case of Japan for a moment, why didn't the Japanese suffer from a hyperinflation? Why have they been struggling with this gradual sort of deflationary environment instead?
They were asked to be very polite to help the Republican Party get reelected, and they voluntarily committed suicide through the Plaza Accord and the Louvre Accords. They imposed the system on themselves, created the credit, inflated a huge real estate bubble and financial bubble, and then very quickly found that nobody could service the property prices at the level that they'd grown to as a result of the bubble that followed the Plaza Accord, and suffered 16 years, quarter by quarter, of steady decline in property prices.
They have muddled through ever since 1990, going in and out of recession, and I've heard some debate about whether a negative 2% or 1 or 2% in rate of inflation is really quote-unquote deflation or not. Volcker was recently quoted as saying that he thought...
Wait, first of all, you're using the wrong term, and this was also the wrong term that was used in the article that you sent me, the Rutgers. I mentioned that the economy is divided into two parts. One is the production consumption part, and that's what you're talking about, I think, when you're talking about inflation and deflation. What I'm talking about is the asset and liability part, the finance and property. While the consumer index may have been 2%, the asset price inflation or deflationary index was much more violent, and the rate of asset price inflation or deflation almost always far exceeds and follows a different curve independently of the commodity price inflation. So rather than talk about inflation, you should say either commodity price or asset price.
Got it. Fair enough. Which leads us to our next question. In this, what I understand you would be anticipating is at some point, again, when the carrying cost of all this debt exceeds income to pay for it, that there'll be an asset deflation.
Yes, asset price deflation.
Asset price deflation.
Which typically leads to a commodity price deflation at the point where there is a break in the chain of payments and the economy is disrupted.
One of our pet theories at iTulip is that when this process begins, we'll describe it as a process, there will be asset price deflation, and the Fed will do, again, what they did in 2000, late 2000, early 2001, which is try to reflate the economy, depreciate the dollar, and...
Right. Their solution to it, the debt problem, is to create even more debt.
That's right.
And this can only go on for, at a certain point, this exponential process itself has to collapse.
How would we know if that is likely to happen in one of these instantiations of this process?
You never know in advance where the break in the payment is going to occur. It usually is triggered by a financial fraud or an embezzlement, such as Nick Leeson's, for instance, or an accident, and then the whole system comes down because it's a very fragile system. Most people expect it to occur as a result of bad derivatives trades at a point where there's a sudden change in the price relations of the economy. Somebody guesses wrong, and there can be a destabilizing event. They're almost always triggered by a destabilizing event, which people say is exogenous because it occurs from outside the system and can't be forecast from within the system.
Sure. So a random exogenous event.
Yeah.
Okay. Meanwhile, the system becomes more and more vulnerable to the shock of this kind of event as it takes on more and more debt.
Yes.
We have this theory that we call coupon theory, and it's a way of trying to understand how asset price deflation and commodity price deflation or inflation might occur under the circumstances where the U.S.'s government needs to meet certain liabilities, for example, for government payroll and various other liabilities, and therefore has to print money to meet those obligations. And meanwhile, the value of the dollar is decreasing because there are large-scale sales of U.S.
Well, I disagree.
Okay.
Again, my whole book, Super Imperialism, is about why this does not occur.
Okay.
And that's because of dollar hegemony. The U.S. government has financed itself over the last decade almost entirely by running a balance of payments deficit.
Right.
Because the balance of payments deficit puts dollars into the hands of foreigners who turn the dollars over to their central bank in exchange for domestic currency, and the central bank doesn't have anything to do with these dollars except to lend them to the U.S. Treasury by buying Treasury bonds. So the larger the balance of payments deficit is, the more foreign governments have to finance the domestic budget deficit. And this is a political system again, not an economic system. So until such time as there is a political break with dollar hegemony, meaning with the American political system and military system and everything that goes with it, the system can indeed be infinite. Until the point where the entire world surplus goes to finance the U.S. deficit.
You would not expect that this random exogenous event that hammers the U.S. Financial markets and economy would have an effect on the U.S.'s ability to continue to sell financial assets to foreigners?
That's right. The U.S. ability to sell its asset to foreign governments is limited only by the foreign ability to create an economic surplus. And the basic strategy of America is that the entire world surplus, over and above subsistence, should be turned over to the U.S. economy. And we're still away from reaching that. Europe is going to have to slash its living standards, and the third world will have to slash its living standards, but there's a long way to go. Europe hasn't begun to tax its population by the amount that's needed to support U.S. economy.
So why do all these guys put up with this? I mean,
I don't know. Lack of imagination, or the belief that somehow they have to be part of the U.S. orbit. Certainly that's what the feeling that there is in Britain. But Europe is committing economic suicide, which is why Rumsfeld refers to it as old Europe. You can see the former Soviet countries committing economic suicide. They're losing population, the economy is shrinking, the living standards are going down, and they're forfeiting masses of property to U.S. hedge funds and buyout funds. And they're selling out ownership of their assets to the United States in exchange for holding treasury bonds way beyond the ability of the United States to pay.
So I just wrote a piece that we published yesterday that talks a bit about who actually owns all these U.S. Treasury bonds. And we take two views of it. One is total holders, just sort of the gross holdings. And the picture is pretty obvious. Number one is Japan. Number two is China. And
you get the figures from the Treasury Bulletin.
That's correct.
Yeah.
Now, if you do an analysis where you take those holdings as a percentage of GDP, you get the political picture. Different countries making different allocations as a percentage of GDP depending on their degree of interest in the United States.
I don't think GDP. The key is the economic surplus, not the GDP, and the GDP doesn't tell you about how much the economic surplus is.
The purpose of the analysis, or the thought behind it, is to somehow normalize these numbers, because as a percentage...
You're not normalizing, you're distorting them, because every country has a different proportion of economic surplus to GDP.
I see. So it's not useful as kind of a gross measure of their
There's nothing else
ability to pay?
that's suggestive.
Okay.
But certainly I think the classical economists were much clearer when they referred to the economic surplus instead of just the amorphous GDP.
Okay, that's helpful. One of the things that comes out of this picture, by the way, is as a percentage of GDP, which may not be the right way to do it, Italy, France, Germany, Sweden, Belgium, Netherlands, and so forth own almost no treasuries, whereas the United States is about more than 50%, Hong Kong 27%, Taiwan is like 20%, China is 20%, Japan is 13%. So those are, and Israel is about the same. The headliners here are countries that have some, either they appear to be buying treasuries to support an objective of build export surpluses, or they have some sort of military interest, Israel and Japan.
Or they're just trying to keep their currency constant, and when they get dollars, if what the U.S. knows and what they haven't politically confronted is the fact that if they don't recycle their net export earnings to the United States, then their currency will go up. And there are many things that they could do which they're not doing. They could, when this happened to the United States, for instance, in the 1920s, it imposed the American selling price system. It depreciating currencies, which was very simple. These countries abroad needn't fear their currency going up. They could simply have a floating tariff on imports from depreciating currencies if they refuse to accept more dollars, and they'd use the balance to subsidize exporters, which again is what the United States has done. If foreign countries treated their own economy like the U.S. treats its economy, it would work fine. And in a way, it's almost hard to blame the United States here for operating in its self-interest, but only the U.S. is operating in its self-interest today. It's the only country playing the game.
Well, let's get back to this question of, hypothetically, we have this exogenous random event. The system in the U.S. kind of goes haywire. What do you think would be the impact on the dollar?
There's no way of knowing because there's no necessary connection.
It could have no effect. It could have a big effect.
Right. I mean, certainly it would probably affect the banking system. We don't know whether the Fed would just bail them all out. Too many other variables.
When I interviewed Martin Meyer, his expertise, of course, is in banking and particularly in over-the-counter derivatives. He's written pretty extensively about it. His theory is that by the time the Fed bulldozes a wall open to let everybody out, he has a crowded theater analogy for the derivatives market. He thinks that the thing will just be full of bodies because everyone's going to try to get out to a very, very small opening, and the Fed won't be able to move quickly enough.
That's probably correct. He's a pretty smart guy. That scenario sounds pretty right.
So it sounds like a person who might be worried about this event happening, say in the next 5 or 10 years, in order to hedge such a event, we really need to hedge two completely different outcomes. One might be a commodity deflation, the other might be a commodity inflation.
But again, the asset system is very different from the commodity price system. It's a fallacy to think they're linked. And once you can de-link them in your mind, it becomes much easier to deal with. You're dealing with the financial market breakdown, and it's true. Everybody thought they could get out in October 1987 when the crash came, but the crash came so quickly that nobody can get out fast enough. So October 87 is the basic model you're looking at.
One of the differences, though, would be that the debt levels and household debt and corporate debt and so forth are much more extreme now than they were then.
That's true. Derivatives collapse won't necessarily hurt the household debt problem because, again, they're different sectors, different economies. It's like the weather. It's like saying if there's a financial crisis, we're going to have really cold weather. It doesn't follow at all.
The model that most people actually have in their minds are really two. One is the deflationary depression that the U.S. had in the 30s, and the other is the hyperinflationary depression that the Germans had in about the same time.
They're very different. The more debt there is, the more debt deflation there is. That's what I was saying in the Kansas City paper and in the Harper's article, which was based on it. So debt deflation is a long-term, slow crash. The hyperinflation, in all cases, as I said, comes from a balance of payments drain. And that has to do with foreign policy. It's largely political in character. The U.S. simply wouldn't pay its debt. Very simple. So the U.S. Would act to protect itself. Other countries don't act to protect themselves. So you're dealing with a world economy in which only one economy in the whole world, except for China, is acting in its own self-interest.
So the reason to not necessarily expect inflation of the dollar is because the U.S., pretty much under all conditions that we could foresee, is going to maintain a strong political and military control of its institutions.
Hyperinflation of the dollar would be a political phenomenon, not an economic phenomenon. It would require a political phase change, a step function. A once-and-for-all change by foreign countries that they would break economic relations and military and political with the U.S.
Presaging the hyperinflation in Germany was pretty much a complete loss of political control over the institutions of government.
It was mainly a loss of faith in their own economy. They believed that debts should be repaid. And all of the parties in Germany, after the Versailles Treaty, even the socialist parties, were trying to say, how can we pay this debt? They imagined that they could borrow the money and work their way out of debt. So it was a limit of imagination. Just like in the Soviet Union, there was a malaise. They thought that their Stalinism didn't work, which was correct, and they thought that the only alternative was the American system, which they believed to be neoliberalism, which wasn't correct. Neoliberalism was only used in this country for export, not for the domestic economy. And Russia and Europe had no idea at all of how America really had gotten rich over the last few hundred years.
You talked about the real importance of the property markets in the United States as a main element of the finance economy. How significantly different is the current system from what John Law put together back a few hundred years ago, which was a money system based on land values?
First of all, he organized a financial bubble as a means of getting rid of the public debt. It wasn't really based on land at all.
Okay.
His task was, how do we get the government, the French government, not to repay the huge war debt it has? And the answer is you get the population to voluntarily convert this government debt into stock in a private company. Then you let the private company stock collapse and say, thank God it's not the government. We never default. It's the madness of crowds. Everybody was greedy. And of course, the bubble was organized by the government. And in fact, the South Sea bubble at the same time, every financial bubble in history has been organized by government as a means of disposing of the public debt by convincing people voluntarily to exchange their secure public debt, or in America's case today, Social Security claims, in exchange for stock holdings, and then the stock market is permitted to collapse after being talked up. So it's purely a stock market phenomenon, had nothing to do with land at all. People imagined that there was a land value in Mississippi and New Orleans, but this was just as fictitious as the South Sea bubble and the slave trade in England, on which the South Sea bubble was based, the Spanish asiento.
Do you think the U.S. government will happily crash the housing market and dispose of some public debt that way?
What it would like to do is have people exchange the rights for Social Security for a stock market right. Channel Social Security by privatizing Social Security. They'd steer this money into the stock market. I wrote my Harper's article on this.
Yeah.
And then that'll push up stock prices in the short term, create a bubble, and then once more retirees sell out than new workers buy, the market will turn down, and future retirees will be left holding an empty bag. So again, it's a stock market bubble.
We have an analyst on iTulip that is actually a chemist by training, but he spent a lot of time doing an analysis of the U.S. stock market, the Dow, going back to the 1920s, and has determined that there's an actual real yield over this period of time of about 1.64%. And he has this inflation-adjusted Dow that he does. And using his model, that the stock market is very, very, very high right now. Do you think that that is mean reverting and probably quickly reverses slowly? Agree with that?
Yes, the problem is that when the stock market goes up, this does create capital gains, which bailed out pension funds for a while. But at the same time, the higher the capital gain, the lower the current rate of return. And the low rate of return is hurting the pension. Higher the stock market, boom, the lower the current payout. And that means that stock markets on an actuarial basis have to report they're being underfunded. And you're having, in the next few months for the first time, you're having, as a result of the Pension Benefit Guarantee Corporation's rewriting of the pension laws, both here and in Britain also, companies are having to report their pension funds on this new rate of return basis. And up until about a year or two ago, the minimum rate of return expected by any corporate pension fund was 9.5%. As you know, they're not making that at all right now.
Yeah.
So the low rate of return is forcing companies to put more and more of their earnings into their pension funds rather than paying them out as dividends. And of course, this is leading companies to, it's preventing their stock from going up because of the diversion of earnings to pension funding. So that's the crisis that's facing the economy right now. And it's a reporting crisis more than a real crisis.
And why were the rules changed to make this?
Because companies are beginning to use the bankruptcy option as a means of wiping out their debts to their employees. Pension funds are legally deferred wages, and the company said, wait a minute, if we go bankrupt, then we don't have to pay, then we shunt the pension fund obligation onto the PBGC, government takes it over, and then we pay off all the other creditors, and in the process wipe out the stockholders. So that was their response to the over-indebtedness. And the real problem, of course, isn't the pension funds at all. The real problem is that so many companies have increased their debt as a result of leveraged buyouts or just over-borrowing and leveraging, or borrowing money to buy back their own stock.
Okay, and so this is really the government protecting itself from corporations, leaving them holding the bag.
PBGC did, yes. That forced itself, its self-protection forced the companies to give honest reporting. And honest reporting is antithetical to growth in America, corporate sector has been fictitious capital, or what used to be called watered costs, increasing bonds without increasing the means of earning money or the means of production.
Yeah, the Wall Street Journal mentioned in an article a couple of weeks ago that the debt rating of the number of companies with a junk bond rating was 30% in 1980 and it's 70% now.
Yep.
Is that an effect of corporations making use of cheap debt?
Yes, both for mergers and acquisitions and corporate raiders buying them out.
Does this leave American corporations more vulnerable to the kind of downturn we're talking about here?
Yes, more fragile, as Hyman Minsky would have put it.
Bernanke has famously talked about dropping helicopters of money to prevent a deflation. The vice president of the Dallas Fed gave a lengthy presentation on what the Fed would do if it were confronted with what appeared to be a self-reinforcing debt deflation. And what it would do is move a bunch of items that are currently in the restricted columns, restricted by the Federal Reserve Act of 1913, and move them into the unrestricted column, including mortgages, stocks, whatever. So they would simply print money and buy things.
Mm-hmm. They'd certainly buy them from their leading campaign contributors. I think the other people would be left out. It helps to be an insider in such situations. You can make more money on a deflation than you can from an inflation if you're an insider. But if you're not an insider, then you're in the position of, say, the Russian public during the asset grab there. There will be a huge asset grab and reimbursement, sort of like sending all that money to Iraq.
The 363 tons of cash.
Right.
So they could send a few thousand tons of cash around the United States to certain people.
Not around, yeah. This is not going to be evenly distributed. It's not going to be a bell-shaped curve.
How would a normal air-breathing citizen of the United States, who is clearly not going to be on the list...
There's no defense. There's nothing they can do.
So you can't prevent your current savings from either being deflated away or inflated away.
Well, they could put their money abroad, or they could buy an actual asset. I mean, they certainly will have the money in the bank will be insured. I don't think they're going to lose the money that way, but the question is, what will they do with the savings? What will there be to buy with it? The stock market will probably go down. The bond market will go down. Probably there's not going to be much money. I don't think the housing market will help very much, although I think if one's going to have a house, it's best not to have any debt at all.
Yeah, I follow your prescription. I don't have a mortgage.
Neither do I.
And I also have like you, I have most of my money in short-term treasuries and CDs and so forth.
Yep, that's what my wife and I have, our money in.
So, that being the case, how about, I'm not getting too hung up on the details there, but I guess one thing's still not clear to me. We'll throw out some potential before and after numbers here. Let's say 2 years after the event, whatever it is, could you have a situation where the purchasing power of the $100,000 that you had in the bank 2 years before is the same with respect to things that you would normally buy every day, food?
Wait a minute. Only you're talking about 0.1% of what people buy.
Yeah.
99.9% of all monetary payments are for assets. They're for bonds, stocks, and real estate. 0.1, and you can look at every day an amount goes through the New York clearinghouse that's more than equal to an entire year's gross national product. So most money is not spent on goods and services. Hardly any money is spent on goods and services. It's almost all spent on assets.
And so these inflation numbers, the CPI and all these other numbers that we continuously hear and that the Bureau of Labor Statistics mentions is really not particularly relevant.
Not if you're doing a monetary analysis. It is relevant for national income analysis. It is relevant for seeing the position of most people, but it's not relevant for monetary analysis.
The mean net worth in the United States right now is about $227,000, liquid and illiquid assets. Let's say that $200,000 is sitting in real estate, it's in stocks, bonds, and so forth. If people wanted to preserve as much of that as they could, they'd do what you and I are doing and put it in CDs and
Well, wait a minute. Although some of it may be in stock, technically it could be in, say, a retirement plan that they can't touch and have no control over.
Right.
So the only part of that most of the average person has control over is their real estate. The average person has such a negligible stock or bond holding over which they have control, and their short-term assets are overwhelmed by their short-term debt.
The mean holdings in IRAs and Kios is about $16,500.
Yeah, that's not very much.
Not very much money. Against a total net worth of $227,000.
That's right, and we're talking about real estate, basically.
Yeah, 46,000 of it is liquid. 62,000 of it is in housing equity.
Right.
So it's mostly housing.
Yeah. And they'll continue to live in the housing.
Yeah, because they can't move. They can't
That's
sell.
right.
Well,
Yeah, they'll be pretty much frozen in.
now what about unemployment? Isn't that going to tend to rise in that?
I think so, yes. I'm sure that a lot of companies are going to become insolvent. They'll have to lay off. And most of these people with heavy mortgage debts are, as they put it, one paycheck away from default. And as a matter of fact, Alan Greenspan made this point. He said the reason that wages haven't risen in this recovery, he said this a few years ago, is because people are afraid of job insecurity and they're afraid of being fired. And one of the reasons is now they have so much mortgage, they think they've been getting rich off their houses, but what they've done is gone so far into debt in order to get rich that they can't afford to go on strike, so now they're not making the money anymore, higher wages, and they're all being squeezed. So if unemployment goes up, you're going to have a huge default and a loss of houses to people with ready cash.
The FDIC put out a report a couple of years ago showing a very strong correlation between unemployment and housing prices. It's pretty much the only strong correlation out there.
Right.
So if that happens, a lot of people are going to be obviously underwater on their mortgages and so forth. They're going to want to just walk away from their property and go find a job.
It's hard to walk away. They're going to try to stay in the property. There will be a lot of pressure on government like there was in New York after 9/11, where people didn't have to pay their mortgage for a year or two. So the banks don't want to repossess the houses because that's going to make their balance sheet look bad. So they're going to say, okay, there will be special things people can afford to be in arrears for up to 12 months, and we're not going to count for arrears. We're just going to keep adding the mortgage payments onto the debt, but not actually ask for more money. So the debt is going to go up very sharply during this period without any money actually changing hands.
What you're reminding me of is I interviewed a guy named Jim Finkel who runs a fund that packages CDOs for hedge funds. He puts together CDO products, and he used the expression, a rolling loan gathers no loss.
That's right. That's how Brazil financed itself until the 1982 crisis. They just would add on the foreign debt to the interest to the debt every year, and that's the compound interest curve.
In your view, all this sounds like a pretty significant recession, if not worse, in the United States. This won't bother U.S. creditors overseas?
There's very little they can do.
Well, they could not buy as much debt. I mean, they wouldn't necessarily sell.
But we're talking about governments here, and the governments will turn all of the dollar inflow into treasury bonds. So if private investors overseas dump their dollars, these dollars are going to be turned over for domestic currency to the central bank, and the central bank will immediately buy treasury bonds with it. So dollars will never really leave America. It'll just be moved from private foreign account to foreign central bank account.
So the United States, if it's going through this really significant recession or depression or whatever you want to call it, obviously...
Crash. Let's say crash.
We'll just call it a crash.
Because we're talking about a financial crash. Remember, we're talking about the property and finance economy. The fire sector is distinct from the real economy.
If it's going to create a lot of unemployment, then that's going to also affect the industrial economy.
That's right.
So,
left of it.
So that the United States would expect it would import less, and therefore be less.
No, why would it import less?
Well, because it doesn't have any people in jobs.
That hasn't stopped them in the past, but okay, there'll be some importing less.
Is there any correlation between appetite for U.S. Treasury debt and the ability of consumers to keep this trade deficit going?
Yeah, because what the trade deficit equals the foreign purchase of Treasury securities. So, yes, you're right. I was exaggerating slightly for effect there, but the U.S. will continue to import, just not so much. Probably people who don't have a job will not buy a new foreign car.
Well, one of the theories we bat around over at iTulip is that if that were to occur, it would be at least in the interests of our trading partners to trade more among each other and less with the U.S. in order to make up for the shortfall in demand from U.S. consumers.
Yes, you'd think, but I would have thought years ago, for instance, why does Germany deflate its domestic economy, as it still does? Yeah. Why does it have so much underemployment there? And depending on the U.S. consumer for its market, it's giving away its goods to American consumers rather than to German consumers. Again, it's not acting in its self-interest. But Europe is in such a mess, you have no way of knowing what irrational people will do. And it's just not rational.
So my understanding from talking to friends of mine in China is that the Chinese are doing their damnedest to try to develop less dependency on the U.S. and do more trade with everyone else, Canada, Latin America.
They're trying to
Russia, everyone else.
They're more interested in figuring out some way of disposing of all of their dollar holdings before the dollar goes under. They would like to exchange their dollar holdings for ownership of foreign raw materials resources.
Right.
They really have not been developing the domestic market to anywhere near the extent to which some Chinese are advocating.
Right.
So they're still very Thatcherite.
This gets back to the question of the dollar going under. I thought that everyone is going to support the dollar no matter what, because they have to.
It's sort of like a hot potato. The world community in general will support the dollar. America's allies, Europe will support the dollar, but China knows that, well, there's no way America can repay the entire dollar debt that it already owes to China. They would like to diversify. There's nothing else for them to hold financially. They'd like to turn these dollars into direct ownership, just like Americans have been trying to buy direct ownership of Europe and the rest of the world for the last 50 years.
Could they potentially play in this crash or crisis the role of de Gaulle in the last one? Where
no, I don't see any sign that, for instance, what de Gaulle was able to do is to cash all these extra dollars every month in for gold.
Yeah.
And you'd see month by month in the Federal Reserve Bulletin the gold cover of the dollar going down. But now the dollar has no gold cover any longer. The problem is that if China dumps the dollar, it'll reduce the value in Chinese currency of its own dollar holdings and thereby weaken the balance sheets, both of its government and of private dollar holders. And it doesn't want to do that. It would rather diversify into asset ownership where it could somehow denominate its debts in non-dollar form. It's actually happening very rapidly by historical standards, although it seems to be happening slowly because there's so little international assets up for sale. If China had its way, it would spend $500 billion, I'm sure, on buying up Latin American and Asian and European mines and other hard assets.
So they actually announced that they were doing that like a couple days ago, that they're pledging $200 billion for exactly that purpose. So they seem to be pre-announcing some relatively large, moves in the direction.
Well, they're saying, here, folks, we have the money. Who wants to sell us their mineral resources and other assets?
In light of that, I didn't really expect a dollar crash, but kind of a gradual deflation.
Yeah. You don't have to expect a dollar crash to do that. They just have no reason to hold Treasury bills yielding about 4%, while what they need to grow is raw materials. They're looking for a way of bolstering their real economy, not the financial economy. So they want to turn these dollars into some sort of control over the raw materials that they will need to import. I mean, if they would like to buy Siberia, I'm sure, from Russia.
Sure. And Russia probably want to sell it to them, too.
Well, I don't think so.
No?
No. Russia doesn't need any money right now. And
no, they don't. Putin's been pretty assertive lately on the geopolitical scene.
That's right. That does not suggest he would like to sell out to China.
Or to anybody. Instead of following U.S. interest, follow your own self-interest. You'd probably want to figure out a way to kind of get together with some other countries and put together your own trade group so that you could reduce dependency on the U.S.
That's correct.
You might start with a core group, say Russia, China, Iran, and Venezuela, just to get started.
Yep.
And would that be a reasonable starting point?
Yes, it would.
And then you try to collect some other guys into your group?
Yep.
And then you try to gradually, say, move to euros and yen in addition to dollars?
That's right. You buy out Australia and the whole area there.
It's interesting you mentioned Australia. I have a central banker contact of iTulip in Australia who said that the United States had been over for a visit to Australia recently and made it pretty clear that they had to pick the right side. China had visited about a week earlier and said they made the same point that they had to pick a side one of these days.
That's right.
Maybe Australia winds up being kind of the linchpin of a changeover to a new monetary.
Well, it'll be a litmus, part of the litmus test.
Given that Howard was recently beating up on Obama,
right.
maybe what he's really doing is reminding the U.S. whose side he's on.
That's true, but on the other hand, if you look at the number of Obama's response was, look at the number of troops he has over there. He's certainly not putting his troops where his mouth is. Okay, to sum it up, we're pretty vulnerable to some sort of random exogenous event. No one can know what it is or when it will happen, and that it would result in a deflation in asset prices in the U.S.
unknowable impact on the separately running industrial economy, so there's no way of saying what will happen to commodity prices. And the dollar will probably go through that process again in a way that's hard to determine. Depends on how some of these other countries that are gathering together recently behave. Perhaps they take advantage of the event or not.
Well, all the interesting questions you're raising are what economists call exogenous. They're outside of the model. So the economists don't really have anything to talk about any of this. They only talk about the business as usual scenario. And you're talking about the real world where only a portion of the future is business as usual.
And the rest is unknowable.
Or it's political. And I think you wrote in one of your emails that other countries, certainly other people are preparing for this and have a plan worked out, and most people don't have a plan worked out. They're planning on just responding to a given situation, and people who are the insiders are thinking way ahead like a chess game.
Of course. Well, there'll be a lot of political opportunities. If there's a lot of unemployment, generally creates a lot of political opportunities for populists.
Usually very unfortunate ones.
The knowable is the mechanics of the markets in this sort of ratchet cycle. The unknowable is the political response to it.
Well, the derivatives market is so untransparent right now that there's no way of knowing who owes what or to whom. When there is a break in the chain of payments, you really don't know where it will go until after the dust settles. It's all kept in a black box.
All right. Well, really appreciate your time, Michael.
Okay, thanks, Eric.
All right. Take care.
This is Eric Janszen of iTulip, and that concludes our interview with Dr. Michael Hudson. I hope you enjoyed it.